Hi children, today we are going to solve the examination problem from the chapter Incidence of Tax. See, basically this problem has appeared in November 2017 and this belongs to the section C, which carries around 12 marks. First, I'll read the problem, children. Later on, we'll solve accordingly. Okay. Mr. Krishna furnishes the following particular on his income earned during the previous year, 23-24. First one, profit from the business in Chennai. See, Chennai is located in India. This we can treat as an Indian income. How it is an Indian income? Because Chennai is in India. Any income which is earned in India, received in India, raised in India, accrued in India. This four item, if it falls any one, then we treat that as an Indian income. Okay. The second, income from an agricultural in Ceylon. Ceylon basically is in Sri Lanka. So this we can directly say as a foreign income. Income from property in Mexico received their rupees 2 lakh. See, Mexico basically it comes in the American. It's an American country, but it's a separate country. But it comes, I think, in the Northern America. Falls in Northern America. So Mexico directly we can say that as a foreign income since nothing is received in India. The property is in Mexico and received in Mexico, earned in Mexico. So basically, we treat that as a foreign income. Now, coming to the fourth point, interest on Singapore development bonds, rupees 1,50,000. In the bracket, they have written 1/3 received in India. See, this is very important. Interest on Singapore development bond. That means I have invested. Mr. Krishna has invested in Singapore development bonds. That basically is a foreign. Out of that 1/3 received in India, that means 1,50,000 is the interest which what he has received divided by 3. It comes to 50,000. 50,000 amount received in India. So that means 50,000 becomes Indian income since it is received in India. The rest, the balance 1 lakh that we treat as a foreign income. We'll go to the next one, children. Income from business in Kuwait, controlled from Mumbai, rupees 85,000. Rupees 35 received in India. It's the same thing. Income from a business in Kuwait, controlled from India. This is deemed to be an income. Why? Because so the business is in Kuwait, but controlled where? From the Mumbai. That means the head office is in Mumbai. So this category, we call that as a controlled income. So this is taxable in two cases, like 85,000 in the case of ROR, that is resident and ordinarily resident, resident but not ordinarily resident, two cases. It is not taxable in the case of non-resident. But whereas 35,000 received in India, this 35,000 becomes Indian income and it is taxable in all the three cases. Understood, children? That means 85,000 minus 35,000, 50,000 we are going to treat as a controlled income. The 35,000 we are going to treat as an Indian income, which is taxable in all three cases. Okay, next we go. Dividend from domestic company, rupees 5,000. This is taxable in all the three cases. Domestic company here means it's an Indian company. So taxable in all the three cases. Profit on a sale of a building in Bengaluru, received in Nepal, rupees 50,000. Profit on sale of a building in Bangalore. See, you can see the building is in Bangalore. Profit is generated in Bangalore. The sale has happened in Bangalore. So basically, but by default, the amount is received in Nepal. But any out of this four, earned, raised, received, accrued, any one happens in India, that is treated as an Indian income. So this, we treat that as an Indian income and all the 50,000 rupees is taxable in all the three cases. Next we come. Income from agricultural in Punjab. See, Punjab is situated in India. So directly I can say income from agricultural in Punjab, rupees 1 lakh. So this I can say as an exempted income. See, any agricultural income in India that we treat as an exempted. So no need of taxable in all the three cases. It is exempted income, tax-free income. Profit on sale of a plant at London, rupees 50,000. 50% received in India. See, profit on the plant where it is situated in London. When the Krishna sales the profit with plant which is situated in London, the profit which is generated over there in London, rupees 50,000. So that we treat as a foreign income. But here one twist is there where it says 50% is received in India. So out of 50,000, 25,000 is taxable in all the three cases, and we treat the 25,000 as a Indian income. The balance 25,000 I would treat like a foreign income, and it is taxable only in the case of resident and ordinarily resident. So we go to the 10th one. Rent from house property computed in Nepal received there rupees 20,000. See, Nepal is not in Indian territory. It is a separate, okay? So rent from the house property commuted computed in Nepal, received there. Nothing has come to India. So it is taxable. We treat that as a foreign income, and it is taxable only in case of resident and ordinarily resident. Profit from a business in Mysore received in Mandya. So Mysore, Mandya both are inside India. So what we treat that as an Indian income, and rupees 25,000 is taxable in all three cases. Dividend from UK based company received in UK. See, dividend earned basically on shares. When we invest some money, the dividend will be paid by the company. So where we have invested in UK, and dividend is received from the United Kingdom. So both and received there itself. So here this is a foreign income where nothing has come to India. So we treat that as a foreign income, and this is taxable in only one case, resident and ordinarily resident. So now we will go to the chart and do accordingly. We'll come here. We start with the computation of income. Say this is the format how we are going to do in the exam. The format states that computation of total income. On the left hand side, you have assessee. First, we need to write the name of an assessee. Assessee here is Krishna. Krishna. On the right hand side, we have previous year 23-24, assessment year 24-25. See, this is very important. This for the format also, they carry a certain marks. Okay. So then we have a 4 columns where the first column will say serial number, the second is the types of income, the third nature of income, ROR means resident, ordinarily resident, resident but not ordinarily resident, and non-resident. Okay. So one by one we will see the same thing what we have, what is there in the problem, the same I have copied it down. So we'll see which is an Indian income and how it is taxable in the different all these three cases. Profit from a business in Chennai. As I told Chennai where it is, it's in India. So I directly treat that as an Indian income. And is taxable in all the three cases. 50,000. 50,000. What I do, I just copy it down so that, yeah, 50,000. So profit from the business in Chennai. Why it's taxable in all three cases? Because see, it is Chennai is in India, and I have earned the business. I was running a business, and profit was generated inside India. As I told, Indian income. If it is an Indian income, 4 conditions need to be there. One is if it is earned in India, raised in India, received in India, accrued in India. Any one category, if it fulfills, that we treat as an Indian income. In case of a foreign income, anything which is raised, earned, received outside India, that we treat as a foreign income. So deemed to be income where the received and raised will be outside India, but the head office or which is controlled from India. I told the example of an Indian embassy. So these three things we need to remember before doing the computation of total income. So next we will go income from agricultural in Ceylon, rupees 1,90,000. Where Ceylon is in Sri Lanka. So what actually the agricultural where they have what do you say? The land has been plowed and then income has been generated from the agricultural in Ceylon, in Sri Lanka. So we treat that as, Ceylon is not in India. So we treat that as a foreign income. I just write it down as a foreign income. So this, if it is a foreign income, that is only taxable in one case, that is one resident and ordinarily resident. In rest other two cases, it is not taxable. Just I'll mention it 0, 0. Okay. Okay, children. Then we go to the third one. Income from property in Mexico. Mexico, where I told it's in Northern America. So basically, Mexico also is one of the country where they say income from a property in Mexico. From the property they have generated some this one income that is received in Mexico. Mexico, it's not inside the India. It's a foreign country. So directly I do write as a foreign income. So here in income, only one column it is taxable, only for in case of if the individual is a resident and ordinarily resident. The other two cases is not taxable. Okay, next. Interest on Singapore development bond. See, the person has invested in the Singapore development bonds and is earning an interest worth rupees 1,50,000. Okay, one third received in India. Two incomes are there. The interest fully I can say which is earned there I will say as a foreign income. In other case I'll say it as an Indian income. Which is an Indian income in this one? See, one third received out of 1,50,000 divided by 3 we get a 50,000, which is Indian income. Why? Because Indian income, because the amount is received in India, and if it is received in India, it is taxable in all the three cases, say resident and ordinarily resident, resident but not ordinarily resident, and non-resident. All the three cases, it is taxable. Why? Because it's satisfying one of the condition. It is fulfilling one of the condition where amount received in India. Rest the amount which I subtract 1,50,000 with 50,000 that I call it as a foreign income. So I'll just mention it as 1 lakh. 1 lakh is a foreign income. Understood, children? I hope so you have understood. So, sorry, that is taxable in only one case. If it is a foreign income, it is taxable in only one case. I'll mention it as a 0 in both the columns. Okay, fine. We'll go to the next one. Income from a business in Kuwait, controlled from Mumbai. Again, the business is running in Kuwait, but controlled from Mumbai. The head office may be in Mumbai. The payment may be doing from Mumbai. So again, this I will call it as a controlled income. But one more thing, what they say, received in India, certain portion what have the amount received in India, I treat that as an Indian income. So controlled is taxable in two cases. If he is a resident and ordinary resident, resident but not ordinary resident. So what do I do? Out of 85,000, I should minus 35,000. Why 35,000? 35,000 is taxable in all the three cases because the amount which is received in India. So what I do, it is taxable in all the three cases. Controlled income is taxable only in two cases. If I minus 85,000 minus 35,000, I will get 50,000. That is taxable in two cases. Rest non-resident, it is not taxable. Understood, children? We'll go to the next one. Dividend from a domestic company, rupees 5,000. See, any dividend which is received inside India. Here, domestic company, we say that is Indian company. So it is taxable in all the cases. I do write as an Indian income and 5,000 is taxable on all the three cases. What do you mean by dividend? I think, hope so, you know what do you mean by a dividend. If anything which is invested in the shares, at the quarterly or off yearly or annually, they may, the company, if it comes in a profit or if it earns in a profit, the company will give to their shareholders a certain portion of that we call it as a dividend. So any dividend received inside India, it is taxable in all three cases. So next, profit on sale of a building in Bengaluru received in Nepal, 50,000. I treat this as a this as an Indian income. Why Indian income, children? Because see, the building is in Bengaluru, right? Profit is earned in Bengaluru. So only the received part is in Nepal. I told if I state as an Indian income, earned, received, raised, accrued. For any one, if it is there, that we treat as an Indian income. So here, profit is earned in India. So we treat that as a 50,000 taxable in all the three cases. I'll mention 50,000 and treat as an Indian income. Okay, children, we'll go to the next one. Income from agriculture in Punjab. Where Punjab is? Punjab is in India. So any agriculture income generated inside India, it is exempted. It becomes exempted income. So no taxable on agricultural income. So what do? I say this, I am going to write it as 000. Why? Because it's a tax-free. We call it as a tax-free. In case here I do, why I'm not writing here? Because the total will not appear. If I mention as a tax-free or not taxable, the total will not appear. So instead of that, I mentioned as 0. Okay, children, we go to the next one. Profit on sale of a plant at London. Rupees 50,000. See, London, he has sold something. Once he has sold a plant over there, that means a machinery, he has gained a profit. See, 50,000 he has gained there. So that part I'm going to treat as a foreign income. Okay. which he has income which he has gained there. I mention it as a foreign income. Rest, whatever the amount received here, 50%, that I treat as an Indian income. So here we are going to split it where 50,000 he has received. I say 25,000. 50,000 minus into 50%, we call it comes to 25,000. So 25,000 is taxable in all the three cases. Since why it is taxable? Because money is received in India. Foreign income. See, foreign income, how much it is? They say 50,000. Once, if I subtract 50,000 by 25,000, how much do we will be pending? 25,000. That is, foreign income is taxable only in one case. So, fine. So, this is okay. Next we go. Rent from house property computed in Nepal received there, rupees 20,000. See, income also generated in Nepal, house property, rent on house property has been taken care in Nepal, income generated there, earned there. So we treat that as a foreign income. So if it is a foreign income that is taxable in only one case, so I do write as 20,000 in the column resident and ordinarily resident, and rest both the columns it is not taxable. Next we come, children. Profit from a business in Mysore received in Mandya. See, both are in India. Mysore also in India, Mandya also in India. Basically, both are in Karnataka. So we treat that as a Indian income. Since the income is earned in Mysore, received in Mandya, both are inside India. I say that as an Indian income. And if it is an Indian income, it is taxable in all the three cases. That is resident and ordinary resident, resident but not ordinary resident, and non-resident. Okay. The last one, dividend from UK-based company received in UK rupees 27,000. See, dividend, he has invested some amount in UK-based company, earning a dividend. Either it can be yearly, quarterly, whatever may be. Received there is in UK. None of the amount has come to India. So we treat that as a foreign income. And foreign income is taxable only in case of a resident and ordinarily resident. Thank you, children. I hope so you have understood the problem. If there is any query, please get back to me so that, or you can mention it in the comment section, comment box, so that I can get back to you. Thanks a lot, children, for watching the video. Okay, thank you.